Good afternoon, ladies and gentlemen. Welcome. My name is GB100. I hope you all are having a wonderful day. Today, we are back with another video that I'm pretty excited for. Today, we're going to be talking about, is the stock market going to crash? A lot of people are saying stocks are going to crash. A lot of people have been saying that we're going to have a recession, either in late 2018 or 2019, or at the very least in 2020. A lot of people have been saying we're overdue for a market correction, and today we're going to be talking about that. We're going to be talking about it because I want to know, if the stock market crashes, that can be a great opportunity to make a lot of money, honestly. Like if we look at the S&P 500 and see how cheap everything got in 2007, 2008, you can't even see because it's a little bit too far back. But, anytime there's a big market crash, that's a good opportunity to make a lot of money because stocks become very cheap. You can go buy incredibly cheap securities and things will be super awesome for you, right? But that's also a really scary time that you might want to prepare for. If sometimes, in 2007, 2008, you had to worry about whether you're going to have a job or not, whether you're going to have a home to live in. So we're going to be talking about that a little bit today, and I am pretty excited for it. So let's go ahead and jump right in. We're going to start off by talking about the arguments that people are making that we're going to have a recession, and then we are going to talk about why we possibly might not, at least not for a little while longer. Firstly, though, we have to talk about the Federal Reserve raising interest rates. This is the number one thing that people are afraid of, the number one thing that's got people all worried and scared, and it's a pretty important thing to understand. So let me start off by explaining this a little bit. So, the Federal Reserve is the central banking system in the United States. That's what people talk about when they talk about the Fed. And when they talk about the Fed raising interest rates, they're talking about the Federal Reserve sets an interest rate that banks have to use when loaning each other money, or more specifically, when loaning each other Federal Reserve funds. Each bank has to have a certain amount of funds on hand, and I believe that if they loan that amount, or if they loan money to each other, they have to use this Federal Reserve rate. And this is a chart showing the Federal Reserve's rate over the years. Now, the Fed can raise interest rates or lower them, and they do so, I think, every quarter. Basically, the reason the Fed would want to raise interest rates is because if you raise rates, you can keep inflation down and you will also keep prices down. Interest rates will eventually be passed on to consumers because, if you raise interest rates, then that means banks are going to raise the rate that they'll raise their own interest rates when giving out mortgages, adjustable rate mortgages or ARMs. Those are mortgages that are affected every year by interest rates that are influenced by this Federal Reserve rate. The rate that student loans have, the interest rate student loans have, the rate that car loans have, the rate that any loan that a business goes out and gets a loan from a bank or something. Those are all affected by the Federal Reserve rate. So the Fed can raise rates if they want to lower spending and keep inflation down, keep prices down. But when they raise rates, generally slows down the economy. If the Fed raises rates, then people are going to be spending less money. Businesses are going to be getting less loans. They're going to be going out and looking to get less loans. That's going to slow down the economy, and it can, for the most part, kind of hurt the economy. Whereas the Fed will lower interest rates in a recession if they want to try and stimulate growth, if they want to stimulate the economy, get more people, going out and buying stuff to keep the economy working. So this brown bar right here, this represents the Federal Reserve interest rate over the years, and all these gray bits, these are recessions. So generally speaking, correlation doesn't always equal causation, but generally speaking, you can see, especially from 1987 and onwards, when interest rates get really high, you have a recession. And then they lower interest rates and interest rates go down, and then they raise interest rates, and then you have a recession and a market crash. And then they lower interest rates to stimulate the economy. Then they start raising interest rates when the economy does well, and when interest rates get too high, you have a recession. And then they lower interest rates again, and then the economy starts doing well again. They raise interest rates, have a recession, lower interest rates. So right over here, we've had this really weird period ever since the financial crisis where interest rates were at zero. The interest rates were at zero, okay? I don't think that's ever happened before in the history of the Federal Reserve System. And recently, back in 2015, they finally started raising interest rates again. So that's something that's got a lot of investors a little bit worried. Raising interest rates, keep inflation down, but slow down the economy. That's kind of scary. Another thing that's worth noting is that the yield curve has been flattening. So here's another lesson for you. The yield curve is something that people refer to when they're talking about bonds, okay? A bond, I don't know if you know what a bond is, but just a quick refresher for those of you who need a reminder. A bond, a bond is another investment tool that you can use. You can go to the government and say, here, take my money. You can get a bond for 1 year, 2 year, 3 years, 10 years, 30 years. And when you pay for a bond, there'll be a certain rate that you get interest on, right? So if you pay $1,000 for a bond for 1 year at 3%, then you'll get $30 back at the end of the year, as well as your $1,000. It's like any other investment. And generally speaking, you're supposed to get higher interest rates for the longer period that you have a bond, okay? So a normal yield curve, for a 1-year bond, you'll get like 0.75% interest. For a 2-year bond, you'll get 1.1%, 3 years, 1.75, 5 years, whatever, right? That was incorrect earlier. And then once you get to like a 10-year, you're supposed to get, 2.5, 3%, 30-year, 3%. But the yield curve changes. And when the yield curve starts to flatten, that's what it's doing right now. That kind of indicates that investors are worried about the long term, right? If you have a flat yield curve, then that means regardless of how long it is for your bond to mature, you will be getting the same interest rate. So why would anyone go and get a 30-year bond when they can have essentially the same interest rate by getting a 1-year bond or a 2-year bond? And that's kind of because, investors are, pretty worried about the macroeconomic, the long-term state of the economy. And generally speaking, people will say, like, if the yield curve is flattening, then that's an indicator that we're going into a recession. And lately, in recent years, the yield curve has been flattening. I don't know when this chart was made. This says a year ago and current, but you can see, right? The yield curve is flattening right here. It used to look a lot more normal, but it's getting flatter and flatter as the years go by. And that's something that's worrying people a lot, saying it might be an indicator that we're going into a recession. Another thing that's worth mentioning is the Shiller PE ratio. So we talked about price to earnings ratios in previous videos. That's one indicator that you can use to value stocks. When the price to earnings ratio is around 10 or 11 or something, that's considered a pretty good ratio where a company is making a lot of money relative to the price of their stock. But when the price to earnings ratio gets too high, that's an indicator that things are overvalued. Back in the 1999 tech bubble, you had a lot of tech companies that had price to earnings ratios that were 200, 300, 400, and you even have that a little bit now. If you go and look at something like Netflix, a lot of people are really betting big. A 200 right here, a 200 price to earnings ratio on Netflix. That's pretty ridiculous. A lot of people might say that that's a bubble or overvalued. But one way that people measure the market is through something called the Shiller PE ratio. This is a price to earnings ratio that I believe is it's adjusted for inflation, and it's also adjusted for like a 10-year cycle. But some people say that the ways that it's adjusted isn't really effective and that it's kind of misleading at times. But this is also one of the things that a lot of people use to measure whether stocks are overvalued. And right here you can see this is the Shiller PE ratio over the past however many hundred years. Back in the Black Tuesday, that was the start of the Great Depression. Shiller PE ratio was at 30. Great Depression. Black Monday, that was a big crash in 1987. Shiller PE ratio was like 17. This was the big tech bubble of the year 1999, 2000. Shiller PE ratio was ridiculously high, almost 45. And this is today. And today, the Shiller PE ratio is higher than it was during the Great Depression, okay? There have only been 2 times when it's been this high in the history of the metric. And both of them were some of the greatest crashes that the world has ever seen. Some of the greatest crashes and biggest recessions / depression that the world has ever seen. So this is something that's got a lot of people worried as well. Kind of scary stuff. Another thing that's worth mentioning is that right now, we also have more margin trading than we've ever had before. So Okay, here's another explanation for you. Margin debt. Margin debt is something that you can use to trade stocks with. If you want to go right now, you can go and open a brokerage account with a stock trader or a stock broker, and you can go and fund that account with your own money. You can buy stocks with your own money, sell them, you get your own money and everything. So everything's good, right? Everything's a-okay. But you can also choose to get a margin account. A margin account lets you borrow the stockbroker's money and then trade with their money, right? So when you can do that for a number of reasons. One reason people do it is you can short a stock, which means you'll bet that the stock will go down. You can sell it for a price right now and then buy it. You essentially borrow stock from the broker so you can sell it right now and then buy it back later when it's hopefully at a lower price. But you can use a margin account for all sorts of different things. And right now we have more margin debt than we've ever had before. This is kind of ridiculous. Again, you can see correlation doesn't equal causation, but when margin debt gets too high, we generally have a recession. Back in 2007, 2008, margin debt got very high, had a very big, long recession. So this is something that a lot of people are worried about. I don't know necessarily if this is something that could even cause a market crash, but this is something that could exacerbate a crash, right? So if a lot of people are trading on margin right now and stocks start going down by a significant amount, then suddenly they have to fund that. You get something called a margin call. So you have to fund your account before the stockbroker will allow you to buy any more on margin and stuff. So this is something that's, again, I don't know if this could cause a crash itself, but it could certainly exacerbate the problem. But I don't know. We'll see. This is more than $600 billion of essentially fake money that's currently being used to trade stocks. So that's a little bit worrisome. Another thing that's worrisome is something that's called the Buffett indicator. So this is something that Warren Buffett made up a while ago. Basically, it's the ratio of certain equities to GDP. So GDP means, the economy, how strong the economy is doing, how strong specifically the U.S. economy is doing, and equities, stocks. Generally speaking, you're trying to see the best representation of the stock market and how quickly it's growing compared to the U.S. economy. So if it's growing at a 1-to-1 ratio, then that's, again, pretty good. That means the economy is growing just as quickly as stocks are going up, so things are probably valued fairly well. If it's under that, then stocks are probably undervalued to some degree. But if you start getting over 100%, then that means stocks are growing faster than the economy is actually growing. And if that's the case, then that means, hey, maybe we're actually in a bubble. We're valuing stocks much more than they probably should be valued because they're going up. And right now, the economy isn't actually doing as well as the market is suggesting. So maybe they're kind of getting a little bit too high and a little bit too overpriced. And you can see, again, we kind of have higher Buffett indicators. This index, or whatever you want to call it, this ratio gets very high right before a recession. So again, I'm not too sure. This might be one of the reasons that Buffett has always indicated just value investing, buying and holding back in the 60s and the 70s and the 80s because the economy was growing much faster than stocks were. But back during the tech bubble, we had ridiculous valuations for stocks and crash right after it gets way above 100%. Again, getting above 100% for the 2007-2008 financial crisis, crash. And then again, we're getting much higher valuations on stocks. Stocks are getting very expensive right now, and a lot of people are saying that they might be outpacing the economy. The earnings reports might not be able to keep up with what people are expecting, what investors are expecting, and we could be headed towards another crash. I don't know if we will. We might not for a while, but it's something to keep in mind. Lastly, this is just kind of anecdotal evidence, but another thing you can do to try and see if the market is, what people are predicting for the market is you can just kind of try and see what other stock investors are doing, right? You can go and see what it is that Warren Buffett's investing in, what it is that Charlie Munger and Berkshire Hathaway or, whatever other big famous investors you personally want to follow, Carl Icahn or whoever. You can just go and try and see what it is that they're doing. And right now, Warren Buffett is sitting on more cash than he's ever had before. This article is a few months old. I think this pile has actually grown larger than $116 billion since this article was written a few months ago. But yeah, Warren Buffett, supposedly, arguably, the best investor in the history of the world, is currently sitting on more cash than he's ever sat on before. So is he anticipating a market crash? Maybe, maybe not. I don't know. There's a lot of indicators here that are suggesting that we might not be headed towards the best of times. It might be the worst of times, but again, it's kind of impossible to time the market and see when we'll have a crash, if we ever will have a crash. But yeah. We're probably going to be due for a market correction sometime soon, and these are all the reasons that people are saying. So now let me go ahead and make a few arguments that we might not be headed for a crash or any sort of recession, at least for a little while. One thing that people are kind of worried about is here, again, you can see the yield curve is flattening. That's what these other colored bars are, the yields on certain treasury bonds. You can see that the yield curve is flattening, and we are raising interest rates, but that doesn't necessarily mean that we have to go into a recession, right? The entire reason that the Fed will raise interest rates is because the economy is doing well, and they want to keep inflation under control and keep prices down for consumers. That's why they would raise interest rates in the first place, because the economy is doing well. And the economy doesn't really have a lot of indicators that it's going to be doing poorly in the near future. We just had a great jobs report, and I think we have the lowest unemployment that we've had in a very long time. So you could argue that, we're headed towards a recession or whatever, but right now the economy is doing well. And whether or not you like Trump and his administration, he is slashing regulations and doing a number of things that'll help businesses do even better than what they currently are. I don't know. It's tough to say that we're just headed to a recession because interest rates are rising. This is the biggest problem that people are concerned about, but at the same time, this is also a sign of growth, that the economy is doing so well that the Fed will raise interest rates. And again, the interest rates aren't exactly all that high right now. We might not be, even if an interest rate rise does crash the market and cause us to go into a recession, it still might not be for a very long period of time. Another thing that's kind of worth mentioning is that the Shiller PE ratio is something that comes under a lot of scrutiny because of the way that it's calculated. If you go and just look at the S&P price to earnings ratio, the current S&P ratio, it's actually not that bad right now. 24.62. That's a pretty good price to earnings ratio. And if you go and look at the S&P 500 itself and look at a few individual stocks, a lot of stocks have very reasonable price to earnings ratios. Apple currently has a 17 price to earnings ratio at the most valued company in the history of time. They are valued to be worth more than any company in the history of time, and they only have a 17 price to earnings ratio with a forward price to earnings ratio of 14. Also, price to earnings growth ratios are pretty low. That's another thing that's worth mentioning. Certain tech companies are getting kind of up there. Google has a 30 price to earnings ratio, but banks, a lot of banks have ridiculously low ratios. 14 price to earnings, like 11 price to earnings, 15 price to earnings. What's Citigroup at? Citigroup's at 11 price to earnings with a 9 price to earnings, forward price to earnings over the next fiscal year, along with a below 1 price to earnings to growth ratio. So a lot of companies are still pretty fairly valued, I would argue, in terms of how much they're making in compared to their stock. Now, there are a few tech companies in particular, because tech companies always get ridiculous ratios. Amazon at 250, again, Google 30, Microsoft, what are they at right now? 27, 30. You could argue that some companies are getting overvalued, but I don't think we're not in the dot-com bubble right now. We aren't at a point where every single company has a 200 price to earnings ratio, 400 price to earnings ratio. We don't currently have like an Enron out there, I don't think. So the Shiller PE ratio in and of itself isn't necessarily something to be that worried about, even if it is a metric that a lot of people use. Another thing that's worth mentioning is that the Buffett ratio that we talked about earlier, Warren Buffett has already said that this isn't something that he believes is like rule of law. So again, the guy himself who kind of coined it says that it's not even the biggest deal in the world. That's kind of worth mentioning. Another thing that's also worth mentioning is that one of the reasons that Buffett, I don't know if I already said this, but one of the reasons that Buffett has so much cash is that he can't buy businesses. Like, it is difficult to find good investments to spend $116 billion on. And it's also difficult to go and just spend that without driving prices up through spending it. Like there's a problem. There's a reason why this article calls it his problem. There's a problem in spending $116 billion, and I believe Berkshire Hathaway still has 75% of their overall capital invested right now, even if they do have a very large cash stack. So, again, that's something that, keep in mind that a lot of smart money is still invested in the market. But I think the biggest thing that's kind of causing me to doubt that we're going to have a recession in the immediate future is that there really isn't anything that's going to trigger it, right? I don't know what could trigger a stock market crash right now. Again, if you go and look at previous crashes or real crashes that happened for long periods of time, right? I think the 1987 crash was a very brief period thing, but if you go and look at 1999, that was the dot-com bubble. That was a crash that lasted for like 3 years. Send the economy into recession for like 3 or 4 years. And that was something where it was, tech companies were getting ridiculously overvalued. And it wasn't just, Amazon and Netflix and Tesla, just a few companies. It was the entire sector that was just so ridiculously overvalued. It wasn't just, Google's getting up to a 30 price to earnings ratio. That wasn't exactly what happened back then. And similarly in the global financial crisis of 2007, 2008, that was an instance where you had a ridiculous amount of people being unable to pay their mortgage because of a huge housing bubble, right? There was a housing bubble crash, a huge crash in the real estate market that I don't necessarily know if we're in ourselves right now. There are a lot of housing prices have gone up a lot in recent years, but I don't exactly think that I don't think that banks are so tied to this way of investing anymore. And I really don't think that there's going to be, even if we have a housing market crash, I don't think it's going to send the entire world into a recession the way it did in 2007, 2008. I really don't know what could trigger a crash right now. That's the thing that's kind of making me doubt that we're going to be going into any sort of recession, at least in the next year. There is a lot of instability in Washington if the Democrats win the House, which I think they're predicted to do. But if they win the Senate, which is possible, but it's unlikely, that might trigger some more instability and an unclear plan for where the economy will be taken in the future. An unclear vision on economic policy could stir worries and then cause stocks to drop. And then if stocks drop, then maybe margin calls have to be issued and people have to fill this margin debt. And maybe some people won't be able to. I don't know if you can default on margin debt if you file for bankruptcy or something. But, maybe that could be something that could trigger the market. But there doesn't really seem to be a lot of stuff that could go and just cause us to go into a recession right now. I don't know if that's something that's really possible right now. And if it is, like whatever it is that could trigger it, I don't know if that's going to happen anytime in the immediate future. Yeah, we'll have to wait and see, obviously. But I think for the most part, I might stockpile a little bit of cash, but I don't know, man. Maybe the election in 2019, or the 2018 election for seats in 2019. Yeah, maybe that'll do something here, but I don't know, man. I don't know. For now, it's tough. I'm torn because I don't know. I really don't know. Obviously, like it's scary, and I want to take advantage of it if we do have a crash, but I don't know. We'll have to see. Anyway, I think that's enough for this video. I'm just going to go on, keep on rambling if I get this going any longer. So I will see you all in tomorrow's video. Until then, though, happy investing week. Hope you guys have been enjoying. See you guys then. Until then, thank you very much for watching. Good luck in the stock market and have a wonderful day.